this it? Cool. This is Chris. We'll get you set up. Right. Hello, everyone. Gather round, take your seats. Thank you all for being at the 9th annual Startup Boston Week. Woohoo! Yeah, love it. Our mission with this conference is simple: to bring together the entire startup community across every industry, department, and funding stage. Startup Boston exists to connect, educate, and celebrate this ecosystem while serving as a trusted, unbiased guide to the best resources that can help you start and scale your startup or your team. My name is Elena Lobianco. I'm a consultant with TriNet. We help startups and small businesses scale efficiently with HR operational efficiency, and I will be your hostess today. Before we dive in, I do want to give a huge thank you to Suffolk University for hosting us. Suffolk has generously partnered with us for the last 3 years, providing the space in kind because of their deep commitment to supporting Boston's startup community. So if you're interested in exploring entrepreneurship, they do offer a variety of programs and opportunities. They are tabling upstairs on the 5th floor at the Vetter Hall, so be sure to check out their table to see how they can support your journey or how you might get involved to support their entrepreneurial students as well. We have a wonderful session presentation today by Michael Goldenberg, and he will be speaking on monetization that scales. If this is not what you had in store for today, you're not in the right room. But stick around anyways, because it's going to be a great show. I'll pass it over to Michael, and we're going to get started. Thank you.
Thank you very much. It's a pleasure to be back at Startup Boston. I've been to many of these conferences over the years, and even had the nice pleasure of working with the founder of Boston Startup. And part of the reason that I'm here today, hopefully, is to help with, a subject. I know a lot of times when people are starting companies, you're often thinking about the product and customers and product market fit and things like that. And in many cases, it feels like pricing might even be, an afterthought. But hopefully, by the end of this presentation, it will be a bigger part of kind of just your overall strategy and how you think about things, and it won't be hopefully quite as intimidating maybe as sometimes it may feel like. As a quick background just on myself, not to bore you guys too much, but I've spent the majority of my career working in early stage software, venture-backed companies. 3 times I've helped take companies from basically 0 revenue to 10 to 15 million in revenue through A, B, C, D rounds of funding, private equity, all that good stuff. So a lot of what I'm speaking about is just based on the mistakes that I've already made, and hopefully you guys can avoid some of those. The thing I will say about pricing, I mean, it's like one of those things also where there's so many companies, they spend hundreds of thousands of dollars, millions of dollars in some cases, trying to figure out what that pricing strategy should be. And so don't feel intimidated or like this should be simple, because it certainly is not. And if anyone is interested after this in kind of more specific help or whatever, you can always look me up on LinkedIn, because most of the answers to your questions and even like the subjects I'll be covering, the answer is it depends, right, on your very specific business and market and things like that. So a lot of this is somewhat more general, but we'll do some Q&A at the end. And after that, if anyone ever wants, general advice, I'm happy to provide it. So when you think about your product and your pricing, it's one of those things, on the one hand, you don't want to go too low and all of a sudden you're in a bad situation, and, it's always harder to go up than down. But at the same time, you don't want to start so high that you're scaring people off in terms of what you're offering. The biggest, piece of advice that I try and give people is don't do your pricing based off of your costs or things that relate to you. At some point, you're going to have to make those numbers work, right? You have to make a profitable business and things like that. But at first, you got to look at like, what is the market bearing? What is how is it going to be viewed by the people that you're trying to sell it to? And you'll see kind of through the presentation, I'm going to constantly tell you to go back to your prospective customers, partners, people in that area that know that what those people are looking for. So, the other thing to keep in mind is, different markets, react differently. Like if you're going into a commoditized market or something like that, like you're probably going to have to be a lot more aggressive in your pricing, right? Whereas if you're going into something where it's what I would call a greenfield net new opportunity or something that people aren't buying already, then you're probably going to have a little more opportunity to charge a premium for what you are providing. The other piece of advice I will give you is, and this came, I'll tell you a quick story, which is, I was at a company, one of our best customers who was also an advisor to us, their renewal came up and we basically, over doubled their price. And they didn't talk to us for a while. And eventually, when they got over being so upset that we had doubled their price, they called us into a room and they basically said, here are the other types of products, not competitors of yours, but other types of products that we use. And here's what all of them charge, right? And you're up here, right? So also just understanding like that universe of things that you're going to be compared to. The unfortunate truth is, people anchor to those different price points and costs. So it's important, even if you're going to go against that in some shape or form, or you have some sort of theory as to why you can charge so much more than other people, it's important for you to have that context of, the other products similar or adjacent to what we do, where they stand. Because again, that's where people will often anchor. The other thing is, so a lot of the companies that I've been at, I'd say in the course of a 3 to 4 year period, we've gone through 3 to 4 different pricing models, which I do not recommend. Oftentimes you're learning things or you're adjusting and changing from there. But it is one of those things to keep in mind. You don't want to change too often because you end up creating debt of all the deals you've sold with all the different pricing models, with all the different kind of differences. And over time, especially as you build up customers, it just becomes harder and harder to understand, like, well, what did we charge them? What did we give them? How do we continue to evolve what we're selling to them when you yourself have a hard time tracking these things? So on the one hand, it's good to be adapting and changing and adjusting, but be careful doing it too much, because you're going to create a bunch of headaches for yourself as things come up for renewal and things change. And then, of course, you also got to consider the risk of anything that you're doing, for instance, for a new customer. People may find out, and then all of a sudden, an old customer says, hey, why am I paying twice as much? I don't know if anyone's seeing this on LinkedIn recently, but I feel like HubSpot's getting a lot of heat for that right now. So when you think about, obviously this is more particular to SaaS and software-based models, but these, I would say are probably the top 5 that you tend to see, which is the per user seat-based model. All of these, there's the good and the bad, and I'll kind of hit on them as we go through them. Usage-based, I would only suggest that for very specific type of products. Tiered subscriptions, which I would say is generally the most common, especially when you're talking about any sort of enterprise software, some hybrid model in between. So in terms of per seat or per user-based models, this can be good when you know that the user base is going to be growing, basically. And it's very clear in terms of who's going to need it, and you can justify giving them all those licenses. What you will get in terms of, let's call it headaches and pushbacks when you start to do user-based models, is people are always going to sit there and say, do those people really need license? What if we just got it for 4 of the people instead of 10 of the people? And so if you are going to go the user-based model, you will most likely need to come up with some sort of way to have some sort of leveling, because usually within any given product, you're going to have, your super user admin type of person, maybe your average kind of typical user, and then you may even, depending on the product, have like a very light user that you need to work in there. And if you don't have those different levels, again, you're going to end up creating a bunch of headaches of people trying to do shared logins and things like that, and potentially limit the usage of your product because they don't want to pay for a full license for someone who may use it just part of the time. So you can address that through, sometimes if you don't actually have a formal different roles in your products, you can do that through just different pricing. But something to keep in mind, that it sounds great, but in terms of, the more users, the more value, it keeps growing, that's wonderful. But especially, tight procurement departments will always kind of push back on who actually needs those licenses. Usage-based consumption models, I feel like there's this dream that you'll have such an amazing product that everything will just be user-based or usage-based, I should say, and that it'll be so awesome that everyone will consume and use your product. But what you find is, especially products where it requires them to do a lot of the lifting and to make a lot of the effort, that can be really hard. So I'll give you an example. One of the products I used to sell was essentially like a demand generation marketing type of tool. So of course, the more they use it, the more they'll spend with us, the better. However, that change management of getting people to change the way they were doing that outreach was harder than we thought, and then the usage wasn't as great. So those usage-based models, I think, work really well for products like a Snowflake or something related to computing power, where it's just naturally growing over time. But if you are dependent on the customer really using the product, you may want to be a little bit more careful with that, because it sounds great and it sounds like what you want to tell people, but if they don't have skin in the game, they may not use it quite as much as you had hoped, and then you're going to be in a tough spot. The last one, tiered subscription model, that you tend to see is, if you go to just about any kind of B2B website, you'll see what they call the good, better, best model, There's 3 options. It's tiered. You're trying to lump in different functionality in the different tiers based on, for instance, the size of the company, or to maximize the people who are using the most out of the product. That is, I do think probably one of the most common models. Where it gets tough is, let's say, in the second or third tier up, people may, because you're bundling the different functionality, they may say, well, I need 2 of those 4 things in the middle tier, but now I feel like I'm overpaying for that middle tier because I only need a couple of the things in there. So the other thing, even if you do go down the road of the good, better, best model, I do think oftentimes it makes sense to allow people, for instance, maybe to buy the good model, but maybe add some things on so they don't have to go all the way to that middle model. Now, that being said, you do need to incentivize them to that middle model. So in a scenario like that, I try and build it generally in a way where it's like, hey, listen, if you're using 2 out of the 4 things, you might as well go to the next tier because pricing wise, it's going to be the same for you. And then that hopefully encourages them to use some of the functionality, but also not feel like they're paying for things they don't use. Because that's the other thing. You'll get on, to any sort of sales call. They're always going to try and go through the line items of what's included and, hey, well, we're not using that and we don't really need that other thing. And they'll try and beat you up on those things. So having a pricing model that allows you to defend that more easily to say, hey, listen, yes, there are some things in there you might not need. However, because of the way the pricing is structured, you're actually not taking anything that you don't. Another model that I have used, quite a bit, which is not necessarily mentioned up here, but I do highly recommend, especially if you have a product that is more enterprise, focused at larger companies, organizations, deal sizes, which is very simply, essentially like a customized pricing. So you don't necessarily tell people, here are the different tiers, or here's exactly what everything costs. But basically you would say to them, hey, based on the size and scope of, what we are going to do with you, we will then, build out a pricing package specific to you. And then, of course, they're going to want some elements of like, well, how did you get there? Or what can I do to bring the price up and down? But that allows you to really zero in on where you're going to add value for them, but also make sure you can fit it to their needs, especially if it's something more complex or one-off. So those are all different options for you. There's too many words on this slide, so don't get caught up reading them. So obviously anchoring your pricing around value, right? People are trying to understand, as simple as it gets, right, in sales. Am I saving money? Am I making more money? Or am I de-risking something? Like that is always what it comes down to. You have to frame it in, that context. And I've sold to marketers, to IT people, to finance, accounting people, like it is always the same. Now, when you're selling revenue generating things, that's in some ways easier, right? Because it's like, hey, 5 more deals, and if they're $20K each, you just made an extra $100,000 and you only spent 10, and easy, for you to do, right? Obviously, you have to convince them of, how likely it is you're going to be able to do that for them. But that tends to be a little bit of an easier pitch, I would say. When you're talking about efficiency in terms of the value of the product, that can be, a bit harder because efficiency is time savings, not necessarily dollar savings. They need to be able to convert that efficiency into dollars, which means, let's say we have a product, as the company I work for today does, that, saves you 60% of the time on what you're doing, right? Ultimately, to recognize that savings, they either have to, move someone that was working on that to something else, they have to avoid a hire, or they have to, essentially let someone go. Now, of course, you want them to be able to reallocate the resources or avoid hiring, but at some point they have to translate it because otherwise, if they have all the same people and all the same costs and now they're buying your, solution, well, now they're just paying more, right? And maybe everyone's life is easier, but they haven't actually realized that value. So that's something super important to keep in mind. If you have anything that is efficiency-based, you've got to translate that for them. Here are the other things you're going to be able to do with that free time now. Otherwise, to them, they're going to tell you, we don't have the budget for it. So, and the last, is obviously risk. That's best case scenario. If you have a product that you're selling where it's like they're going to be out of compliance at a certain date if they don't, use your product or something like it, that's best case scenario. I tend not to, see as much of that. De-risking is one way to sell, but I will tell you it's often like, I think, the hardest of the three. Because, right, it's like insurance and things like, people don't realize the risk until something terrible happens, and then of course they realize it. So that's important to keep in mind. Communicating the changes transparently, this is where, like I was saying, over the course of different pricing models and, you're giving different deals to different people, it can be really tough, especially if someone comes back to you and says, hey, like, I've been a good customer. Why? I talked to my friend and they said they got it for, X amount. So inevitably, as you change, adjust, you are going to run into those situations. There's no way around it from my perspective. But I think it is fair to say to people, hey, right, maybe you are paying more than that other person, but right, maybe they have a different package. Maybe you purchase the product a year or two later when we've added, a tremendous amount of value to the product. But again, just to be careful as you offer different things, don't ever assume that no one else, is going to find out about it. And just make sure you have some sort of justification as to, the changes that you're making. All right. Metrics that matter most. So like I said, just having been in the VC universe, in the private equity universe over the last, 20 plus years or so, cost to acquire a customer, right? The most obvious is what they're generally looking at. They want to see that, CAC of usually less than 12 months is, the rule of thumb. A couple things to keep in mind with this is, CAC can be, I've seen it calculated so many different ways. Like a lot of times it's sales and marketing. Sometimes customer success or other things might get pulled into that as well. But it's something to really keep in mind, because whether you are selling directly, whether you're selling through partners, whether it's inbound, whether it's outbound, however you are getting those customers, there is some sort of math of here's how much it costs us to just get their attention. One of the products or companies I work for, we had this huge free product with millions of free users. Well, they weren't free to us, right? And we obviously knew the conversion down the funnel once we got them, but it cost us, I forget the exact number, but it was like $22 per free customer. So even if you have a free product, it will likely cost you money just to even get those free users on. So keeping that in mind of what is that funnel that I can create that is gonna actually, keep my cost to acquire at something reasonable. If it costs you 20 grand to get a $10,000 customer, you've got to start to reevaluate those channels, because the payback is gonna be obviously, 2 years instead of 12 months. Lifetime value to CAC ratio is also critically important, depending on the type of product and audience that you're selling to. It's obviously hard at the beginning to say our average customer is going to be with us for 5 years when you've been in existence for 2, but that is what they're looking at. So when you see, also those churn rates go up, it's beyond obviously the pain of the churn and issues there, but also it's going to affect your CAC to lifetime value ratio, because the assumption is that you're not maintaining customers or keeping them as long. And that's a big red flag, for any investor. Right, the whole idea of a SaaS model is it keeps building on itself, but if you're churning customers at too high of a rate, the CAC's too high, the lifetime value is too low, you start to shrink down to not good numbers. Net revenue retention. This is one that, I probably dream about on a nightly basis of, right, how do we minimize our churn while also expanding our customers? And this has been something, I've certainly seen over the years change in terms of, I would say almost this metric is one that might be the single most important from my perspective, because This one shows, are you delivering value, right? You're maintaining customers, but also, do you have the potential to grow? Because it's hard to just keep on adding new customer after new customer and not be able to get additional revenue out of those folks. So there's a lot of different ways you can try and expand customers, whether that be cross-selling them additional functionality, or if potentially you can upsell them to larger packages. But ultimately, the net retention is the ultimate sign of the value that you are delivering. And that is why investors are so concerned with it. Now, here's the dirty little secret that I'll tell you that might help you guys out a little bit, which is, investors love this metric. There are ways to actually make it look much better. So what I mean by that is, if you max out new customers on what you're charging them, right, in that initial deal, and you only accept hey, you've got to buy everything or nothing, so they buy the biggest package. Well, guess what? If they don't get value, they churn, you have a huge churn, and your net retention looks terrible. However, if you are able to start someone on a smaller package or allow them to grow, it might be something small, but now all of a sudden your net retention looks like it's 200%, even though it's the same amount of money. So of course you want to get as much as you can up front. That seems obvious. However, from a net retention perspective, which is incredibly important to the investors, it's not always the worst thing if they grow with you versus getting it all up front. So just something to keep in mind. Obviously, similar to the average revenue per user growth, that is similar to net retention, and just in terms of, as you grow, are you getting more out of, each user? Because of course, if you are adding more value, the product is becoming more valuable, you should be able to get more out of them. This is an opinion, take it or leave it, but I, genuinely believe it's much easier to sign a customer and raise prices in year 2 and 3 as you've already proven yourself, as you're established, as you're sticky in their environment. If you are delivering on value and offering more, it's not that hard to raise prices on people. Even in a tough economy and all those things, no one wants their price raised, but if you're sticky in there and they're seeing value, it's actually not that hard. Versus if you try and kind of get it all out of them up front, then again, more likelihood that they're going to be disappointed and churn. And, it can be harder. Getting that initial deal in, again, an opinion is, to me, the single most important thing, because, once they start with you, then it's your deal to lose, versus if you come in, let's say, significantly higher than your competitors and they just rule you out from the beginning. Price realization. I don't know if I think this becomes more important as time goes on. The reality is, when you're trying to figure out pricing at the beginning, you're going to mess up. You're not going to have it quite right. There's going to be a ton of scenarios that come up that it's it just doesn't fit them because they don't, maybe they need a portion of your product and things like that. So, I am not as concerned about how much we're discounting particular deals, because I don't think it's always a sign of let's call it a weak sales rep who just threw in a discount. If it's going to win the deal and we strategically need to be somewhere to win a deal, then that's fine. And maybe your pricing model evolves over time as you see, where people are willing to pay and what they're willing to spend, versus again, just, holding to your pricing structure, too firmly and losing out on deals. Because the reality is, especially when you're early on, every customer you can get, it's not just the value of the revenue, which by the way is 10x whatever they're paying you, because that's the multiple you get on it, but is also getting another user into your system that can give you feedback. And there are other ways to get value back out of customers, whether that be a faster signing date or something like that. And then the typical thing that I like to do in any sort of discounting circumstance is get some sort of agreement from the customer in terms of references, case studies, anything that does add value for us beyond just the revenue they're giving us. All right, so effective strategies for price testing. This is the old cliche of like get out of the office, get in front of people, have those hard conversations with not your friends, not your advisors, really like your target audience, whether you use focus groups or, some version of A/B testing, but, get in front of people, get real raw reactions from people. The other thing is, even when you're doing that, right, the thing I've seen a lot of people do that does not work very well is like, hey, look at all this great stuff we do. Would you pay 35 grand for that? And they're like, yeah, sure, I think I would pay 35 grand. Seems like a pretty good product. That in that context is like very, they're not committing to anything, obviously. In those scenarios, I would try and get them to say a price first before like feeding it to them. And I would also, ask some harder questions of like, so you're saying that if this was at this price today, you would buy this. And then all of a sudden you will get much different reactions. So I think just in general, as a startup, as an entrepreneur in general, right, it's like you get two sides. You get the people who just, crap on your ideas and think you're crazy and that part. And then you get the other side who are trying to be nice to you and are like, hey, yeah, 30, yeah, I think that's worth it. I think I'd pay that. So just, read in between the lines a little bit, I think is helpful. But get to people that, you don't know as well, I think is critical. And then kind of what I was saying earlier about finding out other adjacent products and where their price points are will give you, really good context. Again, mistakes I've made. I've tried to sell, for instance, products that add on to a platform, and we were charging more than the platform itself, right? So that doesn't jive with people. Whether your product is truly worth it or not, maybe that's different, but still, if in the context of like they're comparing what they pay for something else, it can make things very tough for you. All right. So some of the things that the investors are looking for is, again, whatever you're saying the price is, like, can you show that value? Do you have even a couple early case studies, and you don't need the long, boring case studies that no one reads, but just some proof points, because the reality is, people talk about product market fit and they say, well, right, if you sell it, basically to a dozen, 100 people, like you've got product market fit. And I would argue you do not have product market fit until you actually are able to show multiple customers receiving value that they can communicate to others, which is what gets you from the earliest adopters to into that middle group of customers. So the investors, from my experience, they want to see that they want to hear from you, like which of your customers or even early adopters are getting value? What value are they getting? They do want to see that. Predictable revenue streams. Oftentimes you hear this concept of a funnel, right? Everyone's got your top of funnel leads and then it slowly creeps down. However, I like to think of it more as a series of funnels, right? Because all the different channels through which you're getting people to come in are going to be different. They may even be willing to pay different things. The conversion rates are going to be different. So when you're thinking about predictable revenue streams, I would think about it by channel to then have your different metrics by channel, because then it becomes a game of, if we put a little more money here, can we grow that channel? Or can we invest in partners or LinkedIn ads or whatever it is? But they want to see some form of predictability, some consistency. And the question they will always ask you is, if we gave you X amount more, could you, continue to get those results? And so just having that grasp of the different streams and how consistent they are allow you to build off of them and then look to introduce new ones. Again, on the one hand, they want to see that you can sell to new customers, but every investor that I've dealt with, they're always looking to see but how are you expanding? Are you going to other departments? Are you just selling more to the same people? Are you just raising prices? But I think we often get so caught up in the new sales, we forget that actually it's not just about that initial sale, it's about actually continuing to expand them. And one thing to be careful of is if you, as an example, do pricing and you give them a product that basically has everything, maybe because you don't have kind of the controls in place to limit what different people get, you can create some issues there because then you have less of a way to expand them if they basically get all the functionality and you're not able to charge them more as they start to use more of it. So something to keep in mind, like my mindset is like, I want to give everyone everything because then hopefully they will use it more. But it is good to make sure that you're not giving them too much that you can't capitalize on it after. And really, again, they just want to see, the different channels, the different expansion, like the consistency, that it's not that you had some bump for some random reason, maybe something happened, with a competitor or something like that. They want to see that you have consistent funnels to drive business, to have the conversions that you can incrementally, continue to improve, and just, beyond just the like, hey, we had a great quarter. They want to know that next quarter and the quarter after is going to be, the same, if not better. All right, so we'll hit on the key takeaways. Anchor in market perception, like I said, going out, like getting dirty, asking the hard questions, not to just your friends, but finding out where you sit in the market, is going to be critically important. I think a lot of times with pricing, people assume like a lower price is better, but it actually often isn't because it just creates the perception that the thing isn't as good, right? So that's why I say I'm not always so concerned about discounting because I just want them to, give it an opportunity, to then be able to see, the value of it. You're going to have to continue to adjust, but, again, be aware of like what you're being compared to, because that's the thing you don't want to have happen. You don't want people to disqualify you before they've looked at the product. One of the questions I get the most is, should we put pricing on the website? Like people always ask, should I put the pricing on? I don't know. I have an overly simplistic answer to it, which is if you have a more transactional, simple to use, less expensive product, then I do think, and you want to have more of a e-commerce play and let people buy it, I absolutely would put the pricing on the website and allow people to go that way. If you have a more complex product that requires an explanation and possibly a more customized pricing, I would highly recommend not putting the specific price because you might just scare people off. And ultimately, you want to have those conversations. And if there is genuine interest, they will. In those cases, I would recommend you can give guidance on how the pricing structure works, which is often what people are wondering. But then I think it's better if you can actually have that conversation when it becomes more complex and it is going to be more custom. Choose and evolve wisely. Again, it's easy, especially when you're a startup, because things are more flexible. And that's the great part is that you can then, adjust quickly. But, be careful because, again, it can bite you in many different ways. People coming back feeling like they were missold or, maybe your customer success team doesn't fully understand what was even sold to them or what they have and don't have. It's unclear where you can expand with the customers. And I'm speaking from direct experience at the moment of like trying to unravel some things from the past of like, we're not even 100% sure like what what those people have. So it makes it that much harder to understand how much value, how much more can we sell to them. Obviously tracking your metrics, that's an obvious thing. But, I do think it's worth it to track, certainly like I'm religious about like win-loss rates, why we lost. Do not believe people when they tell you it's price that you lost on. Not always. Sometimes it is price, don't get me wrong. But more times than not, if you say to that person, yeah, but it's half off now, are you buying? They go, well, it's actually a little bit more, right? People will tell you what they think will get rid of you in some ways the easiest, or the thing you can change, or something they think maybe you won't change. But it is not, oftentimes it's not just the price, right? It's like they don't see the value overall. So even if you drop the price by $3,000, $5,000, whatever it ended up being, that's not going to make the difference for them. They didn't see the value, and it was just an easy out to say it was too expensive. So dig deeper as they're telling you it's just price, but tracking your win losses, who you're losing against, especially if you're in a competitive market, I would really focus your energy on. You're never going to figure out exactly what your competitors are charging for everything, because if it's, like most markets and it's competitive, they're going to adjust. It's like oftentimes in competitive deals, I think I know what generally people are getting charged or what they're sharing for pricing, but they're in a competitive deal against us, right? So now all of a sudden they're adjusting and they're changing and they're dropping their implementation or whatever it is. So you're never fully going to know exactly what your competitors are offering, but just to be able to keep digging in and seeing what it is, what they're saying, that is critically important to then make a good decision on what you're going to change. Good pricing, if it's done right, customers will feel some combination of we are getting a good deal and we are getting good value. Like, it's funny, in software, the sad truth is, like, everyone wants a discount. That just seems to be the nature because, right, it's not a physical product. They look at it and they say, for you to give me this, it's right, it's all, on AWS. Like, what does it matter if you give me X amount off? So the other thing I'll say is I like to, let's call it build in some degree of buffer, factoring in there are ways, you're going to want to discount or be able to be more flexible. And the last thing I'll say to that is there's a lot of creative ways. Like if you're in a SaaS startup, it's all about ARR, right? So on the one hand, you might want to charge for services or other things, but if they don't count as ARR, I would be just conscious of that. And those would be the first things that I would look to potentially flex on and give in a deal, because your service team is working hard to get them onboarded and you want to represent that in dollars, but a service dollar to your business and an ARR dollar to your business are very different in terms of the value to you. So just keep that in mind. All right, and I think that's it. I think we're going to do a Q&A now. If anyone has any specific questions, your first hand up I saw, so go ahead. We're going to pass the mic around.
Thank you. You spoke a lot about pricing, and there's a couple different areas where I was curious how you viewed loyalty, right? Because I forgot the exact. Oh, thank you. Did you hear the question? I can repeat it.
I heard, how do you factor in loyalty?
Yes, because you earlier in the presentation you talked about how to go from it's harder going to raise your price, but I'm curious how loyalty can play a role in terms of and how that's valued by investors. In terms of saying, I'm going to start off low and we're going to grow over time, I think is the terminology you use, versus starting high and you may not be able to build in that loyalty.
So I guess this is the question, just how do investors view that?
Or how to measure it and how do you value it versus other inputs?
So that to me is, net retention.
Okay.
Right? Because that's, are you keeping people? Are they staying? And are you growing them? Those are the two things that I think they're looking for. Where I thought you were going with that is how do you make customers feel good about the fact of being loyal and, to continue with, if you're raising their prices. But one of the things that, as you're introducing new functionality and things like that, is to right, is say, hey, listen, you've been anything I give a customer, right, because everyone wants a discount or whatever it is, incentives. It's always based on, hey, because you are a good and loyal customer, that is why we are willing to do this thing for you. So it is, I do think you always try and build in like an incentive for that loyalty. But from an investor perspective, that's like their favorite thing in the world, right? Like you can, not to get into the weeds of it, but I've been at a company where, long story short, we took out some, we were raising a round of funding, and we were showing essentially like our new ARR was great, and but there was a particular group that was like killing our net retention. So we basically showed that we had lower new revenue, but our net retention went up, and the conversations completely changed. Even though our new ARR was lower, the fact that our net retention looked so much better was more important to them. Now, that won't always be the case. It obviously depends on a lot of things, but because to them, they'd rather see you're growing slower, but once you have customers, they stay and expand versus, hey, we spent a ton of money on sales and marketing, we signed a bunch of customers, and now they're churning. Like that's the biggest red flag for any investor.
Awesome. And then one more quick one, if I can sneak it in here. Double make it. In terms of just two scenarios, in terms of lifetime value, how do you treat pricing differently if the lifetime value for one persona is short, and is upfront and shorter than another persona? And we're talking measuring years. Like one's going to say like a year or less, the other one can be multiple years. Now I go to Mike.
So how do you handle what aspect of that?
The pricing associated with two different personas in terms of lifetime value to the company.
Yep. So I guess, I don't know if the pricing so much is different. What I would say in the past, when I've seen, we have certain customer bases that churn higher. As an example, maybe this is obvious, maybe not, but smaller customers churn more than bigger customers, generally speaking. So in those cases, it's not necessarily we're adjusting the pricing, but often we will adjust the service model.
Got it.
That we are providing to factor in lowering our cost to service them, basically.
Thank you.
Hi, just quick question. So, as you're going in and you're signing your contract for annual renewal, what is your thought about baking in the increase as part of the contract? So, it's a 5% renewal. Is that a good strategy to go as a new business, or is it not so good?
Meaning, should you put it in the actual contract?
Yeah, should you put the renewal rate if you renew, this was what it would be, or I've seen it, in different ways where I've seen actually, as somebody who's buying software where it said, if you renew by this date, your annual renewal will go up by 3% or 5%. And I'm just curious, now that I'm going into a startup and being, leading it, and I'm going to be selling the product, I'm not really quite sure what the right way to do it is.
There is no right way.
Okay.
So I would say I personally prefer to put it in because, two things. They're going to fight you on it, initially when they sign the contract, potentially, if they really want to. I think because inflation has been as high as it was for the past few years, I think people push back on it less. But if you don't put it in, then you've got to be a little more careful as you're doing it to people. How are you going to increase on the renewal? So there's two ways. If you can avoid having to do another contract, that's the easier way, I'll say. But generally, to the point of transparency I made earlier, like I would rather just address it up front. The other thing is, if you're doing multi-year deals, I would encourage you to either, like in the past, what you would see is people would just discount heavily on a multi-year. But if you are giving someone a multi-year, if you just leave the price flat year over year, that is actually a discount because you're not raising the price in year 2 and 3. So yeah, I would be transparent. The other thing is you got to be careful is if you don't tell people that the price is going to go up in the second year, they might, depending on what you showed them initially, they might say, hey, wait a minute, you didn't tell me this would go up. You said this was going to be my price as long as I was here, or they might assume that. Go ahead.
Hey, thanks, Michael. Scenario that's kind of outside the bounds of the presentation, but curious feedback from you or anybody in the audience. Pricing is obviously the lifeblood of a lot of SaaS companies, and we all love the ARR model. But this is a scenario which 3 years later, I still can't figure out how I could have done it better, right? And I came in, PE-backed company, I came in as CRO, CEO started the same day I did, right?
Yep.
We're in, getting to acclimated, it's going, I can see the opportunity, that's why I joined, right? So the CEO who had spent 20 years at a very large hardware company running pricing came up with not only a 3x increase in pricing, but a wildly complex, tiered approach to pricing, had these bundles, and you get, earlier you said you get all these things you don't want, and customers would obviously say it's a problem.
Yep.
And the sales team, my partners, who are 70% of my revenue came from referrals from partners,
Yep.
we're all saying, what are you doing? How can you explain this pricing to me? I can't explain it. I need to open up CPQ or a spreadsheet. And it really, we grew the company a lot, but it stunted growth so much. And it had so many discussions, passionate discussions with the senior team about how the pricing is structurally incorrect.
Yep.
Does anyone, you or anyone else, have any pearls that I could take or anyone else could take about conducting a pricing discussion with an executive team around, you know, where we're at, where we should be, what they don't, because I see it as sales, like I see the outcome,
Yep.
but these conversations get out of control very quickly.
Yeah, you could. That could be about just about anything related to executive kind of communication, right? Yeah. So, I mean, a couple things which you bring up, which I probably should have started my presentation with, which is like KISS, keep it simple, stupid, right? Like that, you know, when people start to get confused or, you know, I've used certain pricing models where it was like, hey, we're going to need like a month to figure out which tier this, that we should use because, you know, it's so complicated the way you made the pricing. But I guess my best advice, because I have been in these situations multiple times, is you got to use data. You got to use quotes. You got to use, if it's, you know, nobody believes, unfortunately, I say this as a sales guy, it's like they don't believe the sales guy. They think we just want to close the easy deal, right? If you can share, you know, real quotes, real data in terms of like deals you've lost, you know, that would be the difference. But the thing when it comes to like pricing stuff too is, you know, again, did you lose the deal because of the price was too complicated or they didn't see the value? So that's why I think, you know, and I love to use, whether you use Gong or any sort of other call recording, you telling someone and them hearing the person say it is two different things. So I would just try and, you know, this is not my opinion. This is what the data and what, you know, the feedback is.
Thank you.
Hey, thanks for the opportunity. Great presentation, Michael. I appreciate it. So my question to you is like, when you have a product that is like both hardware and software, which is my, we are trying to create these drone shows that are like 100x cheaper. So that way we are like trying to keep the customers like, you know, not to worry about more, not to worry more about, I'm super nervous. I don't know why. So,
No,
anyways.
go.
So when you're trying to retain customers in a blue ocean rather than getting scared of like, keeping them together in a competitor market. So in that perspective, do you have any like top 5 advices or like points that we have to take care or like worry about while creating that product? I mean, like trying to create that blue ocean in terms of price.
So just to clarify, are you saying because it's hardware and software, like how would you charge for the?
So for the software, it's going to be B2B, and for hardware, for hardware, it's going to be the B2C and B2B. Yeah.
Got it. So just, you know, in general, like advice on things that are hardware and software. So I have actually been, you know, in scenarios where we were selling like physical goods along with the platform itself. I guess the short answer there is I would try and put as much into the ARR as possible and keep the actual cost of the hardware as low as possible as you can, almost to make no margin on it. Again, I'm not an accountant, but because it just saps up the ARR and you don't get as much credit for it. So as an example, one of the companies that I helped grow was a gifting platform. So right, we charge for the software, but also they had to actually buy the physical gifts that were being sent. And so there was a time where we were trying to like have a higher margin on the gifts, and that was going to be how we were going to share it, with investors and things like that. At the end of the day, they didn't care as much about that revenue. They wanted to see, the ARR. So eventually we took it down to like almost zero margin on the actual physical goods so that we could keep the ARR as high as possible. And then it becomes a whole conversation with people of, sometimes explaining that to say, hey, listen, we're keeping this cost very low, but that's why this, the platform costs more, kind of thing. Oh, I don't know where the microphone
That's me.
went.
Yeah.
Oh,
Hey.
sorry.
I have a comment and a question. So just want to go back to what you mentioned. I wrote it in bold: sticky, sticky, sticky. So
Okay.
the reason is I was while I was working, we had the SaaS tool Sisense. We wanted to change it every year because they kept increasing the price, and we kept reviewing other products, but always we would do a cost analysis on how much it would cost to change and adopt a new tool, and
Yep.
every time it was no. We were like, okay, we'll pay it, we'll do it again next year. And again next year I did the same analysis, again no. So, it's all these tentacles of connectivity into all the systems, and it's very hard to change. So that's a comment. And the question is, I'm at a stage where it's post MVP, getting into founding, looking for founding customers. And obviously there is, I'm going to build my product with the customer now. It's not, I don't have an enterprise ready product where I just go in, this is the pricing model, do you want it or do you not, right? So it's more of, let's work together on me building it. So how do I approach this? Did you have any scenarios earlier that you worked for this? Any suggestions? How do I approach the pricing model? Considering the fact that I have to build it, right? I need a team to build it.
Yeah, so a couple things. The sticky factor depends, that you said at the beginning. I do agree. It depends on the product, and you got to be very conscious of which, because some are easy to switch out and people do it every year, so that one's a little harder. In terms of, so sorry, what was the rest of the? Oh, sorry. With the new, yeah. So when you're trying to get these new people on, so couple things. Leverage either your connections or, right, like usually the first, I would say, rough shot numbers, like the first 12 customers of almost any company are investor referrals. There are people who are like genuinely trying to help out. They're not because it's like the best business decision for them to make sometimes. With those, I would, especially like super early on, like I would try and establish some sort of value-based pricing to understand, hey, if we can do this, right, even, low numbers, do we think it would, drive X amount of revenue? Okay, give us, 30% of whatever we can show we're driving. So yeah, trying to like be at that like super early stage, I'd be more conscious to like not just give a price and go from there, but to like really try and work with them, because you're not talking about someone who is buying a fully built product. Like you're kind of should be paying them a little bit, right, in some way, because they're giving you all that feedback. And then also, as time goes on, make sure you really take care of those customers, because they will be the ones who will be your initial reference customers and referrals and all those things. We're out of time. There was someone in front who had a nice question.
know, I'm
He's been
so
waiting
sorry.
patiently. All right. I'll hang for a little if anyone wants to come after.
We do, yes. Thank you, Michael. Excellent questions. Thank you so much again for your presentation, Michael. Happy to have you here. We do have a lot more in store today. And for the rest of the week, we also have our startup crawl happening tonight. That kicks off at 6:30, right from Suffolk. So there are limited spots. You must be on time. We are super prompt with our departures, and you don't want to miss it. So I know that you guys will want to mingle after this event. We absolutely encourage that. The only thing that I ask is that you do not do it in this room, or I will have to kick you out very politely, but forcefully. So even if your next session is here, I just ask that you kindly step out, recheck in with the folks at the registration desk. If you guys have joined us virtually, you don't need to go anywhere. Just select your next session, and we'll be back with you shortly. So lastly, as you've seen a number of photographers milling around this event, Kevin Tai from 3 Circle Studios is our official photographer. So grab him or somebody from the crew, and you'll get a personalized Startup Boston Week photo album that you can look back on all year. I have a collection of photos. They're super great, and they look fabulous on LinkedIn. Thank you guys again for being a part of Startup Boston Week, and we'll see you at our future sessions. Thank you.
Thank you.